What Donald Trump is hoping is that companies around the world will jump over the tariff wall and set up shop in the United States and serve the U.S. consumer from within the confines, the borders of the United States. And that will create employment. That'll have all sorts of beneficial things. But that may end up being a misapprehension, because if other countries throw on tariffs of their own, it becomes a zero-sum game, and all you get out of it is a shrinking global GDP pie. But no, you're not going to raise tariffs and then believe that it's not going to have an impact on the consumer unless you believe that wages will go up with prices. You see, everything just leads to a ridiculous conclusion. The administration seems to believe that there will be no price impact, that the foreign producer will absorb all the impact of the tariff, which I think is possible, but really more likely wishful thinking. If we get the price shock and people don't bargain for higher wages, then their real incomes are going to recede and they're going to spend less, and that'll have a negative flow-through impact on employment. That actually will frustrate any improvement on the fiscal side because revenues will end up coming down as a result of that. But let's say you'll say, well, at a 4% unemployment rate, people will bargain for higher wages and they will try and compensate for the price shock. Well, then the Fed's never cutting interest rates, because then you're going to get, a wage price spiral. Nothing here is going to be good unless you have this pie in the sky view that the Fed will cut rates because there's no inflationary impact, and that companies around the world will leap over the tariff wall and make America great again by setting up production facilities inside the United States. Those are the assumptions. And if they turn out to be true, then that would be absolutely euphoric. I think it's highly unlikely, but that's really what the gamble is. Rising uncertainty means widening risk premia across all asset classes. It means credit spreads, investment grade high yield, they will be widening. It means that whatever your estimate of the fair value price earnings multiple is in the stock market, that will be declining. And of course, it could affect, layered on top of that, all the fiscal uncertainty, how much duration you're going to want to have in your bond portfolio. So what all this means is that the confidence bands around any forecast, macro or market, the error term much higher than it normally is by several standard deviations. The confidence interval is much wider, the range of outcomes. So uncertainty means exactly what Jay Powell said it meant several meetings ago when he explained why are we going on hold in this environment of uncertainty, is because when you're in a dark room with furniture, what do? You just stand still. And that's going to apply to the economy too. That means liquidity and savings rates will go up in the household sector, the expense of spending. Companies will be shelving capital spending plans because of all the uncertainty. That's what uncertainty does. It has an incrementally negative impact on aggregate demand without you doing anything outside of just creating this incredible period of policy uncertainty. By the way, we saw this in 2019. This is on a much grander scale. In 2019, we had a capital spending recession. That's why the Fed cut rates 3 times before COVID. We didn't have an overall recession because the tax cuts were giving some nice impetus, lingering impetus to the consumer sector. So it means that you've got to cull your portfolio to really best ideas. I think you've got to de-risk your portfolio. If you're in the equity market, I would be in areas that are not correlated with the economy. So the most defensive sectors with visibility, that could be consumer staples, it could be utilities, healthcare. One thing that Donald Trump has made great again is European defense stocks. I mean, the European stock market has had a great year. Of course, there's tremendous valuation support there. But the one thing Donald Trump has done, and appropriately so, especially with this Ukraine situation, is he is forcing Europe to finally live up to its NATO commitments. And all of a sudden, you've got this debt break in Europe. You've got room being made for more defense spending, and not just there, but in Asia as well. Japan's increasing its military budget. So defense aerospace is one area in an uncertain world that has a lot of certainty around their future earning streams. I'd be taking profits in those Mag 7 stocks, which probably should have done a couple of months ago, and deploy those into European defense stocks. So that's what I'd be thinking about in terms of equities. I'd be taking down my allocation, and I would be very defensive, reducing the beta. But there are areas to put money to work, and defense stocks abroad are in a bull market. I think gold is in a secular long-term bull market. I think that is an area that you want to buy on dips. Gold will be making new highs in the next several years. Gold is trading more as a currency and less as a commodity. So gold is trading like a currency that is no country's liability. It's a great balance in the portfolio, and it's extremely correlated with uncertainty. So that is something you want to have. And as you can see, Bitcoin has been crunched because everybody thought that Bitcoin was digital gold. And I kept on saying, no. Bitcoin is correlated with the NASDAQ 100. Take your pick. That's concentrated risk. Bitcoin does not have gold's characteristics. And I would say the Fed will be cutting rates, I think more aggressive than what's priced in. So I would say that the Treasury market, you can pick your spot along the curve. I think Treasuries will be a very good place to be in the next 12 months. The S&P 500, as tough a year as it's been, it hasn't broken down, but the NASDAQ is pretty well broken down through all its major averages. And that's what I said before. Bitcoin is the NASDAQ on steroids. So it's just another form of a risk-on trade. And the most high beta risk-on trades are the ones that have been faltering the most, by the way, including the Mag 7. I haven't seen the financials falter. I haven't seen healthcare falter. It's really been the high beta, high risk, high multiple. The most risk on trades are the ones that have been faltering the most. And yes, is that a leading indicator? It normally is. And you saw that the last time we had a gigantic price bubble in the late 1990s. What was the first bubble to burst? Was NASDAQ. Now, we didn't have Bitcoin back then, but the riskiest stocks fell the most. And everybody thought, well, but the rest of the market will be protected. And that worked for a while. The NASDAQ peaked in March of 2000. People have to know their history. It does help. And then the S&P peaked in September. Nothing was safe. It was all basically you could be in value stocks. They went down by less. Going down by less, if you're a relative asset manager, that's great. The market's down 40%, you're down 15%. I imagine on a relative basis, that's great. But if you're an absolute return manager and you don't want to lose your clients any money, you want to de-risk as much as possible, because all these various, although I say get defensive, what I mean is at least you won't get killed in the defensive stocks. It is interesting that the only stock that never really goes down in a recession is Walmart, but it doesn't really make you money either. You're probably better off in the bond market, like in recessions. And this is what I mean. Everybody believes after 2 years of 25% gains. You see, I should have answered the first question, what's bugging me the most? I talked about uncertainty. Everybody is all in the stock market. Everybody's all in risk all at the same time, and everybody believes they can time the exit. So the degree of concentration of equities and household balance sheets has never been as high as it is today, including the dot-com and technology bubble of the late 1990s. Everybody is all in at the same time. Nobody is rebalanced. Nobody's taken profits. Nobody's diversified. In the past couple of years, diversification in your asset mix has become a dirty 15-letter word. I've been in the business for 40 years? I have never seen this before. So I'm a little nervous about what happens if the stock market, if we're both right that what's happened in Bitcoin and NASDAQ are leading indicators for the stock market in general. And I'm talking about the S&P 500, which to me is the bellwether. I'm worried about what that negative wealth effect is going to have on confidence and spending, layered on top of what the tariffs will do to real incomes in real time. That's one of my biggest concerns, is that people built up this hubris and complacency and arrogance that is incredible. 2 years of 25% gains in the stock market fueled by ChatGPT and Nvidia and the like, and then people believe in themselves. They believe that they're geniuses, and they believe they are the next Warren Buffett. Everybody thinks that they're genius investors, and everybody is all in at the same time. Even people, boomers over the age of 60% of their portfolio is in equities. It should be 30 when you look at the time structure for people that are getting my age or older. I'm really nervous about what the next bear market, but people don't believe in bear markets anymore. There's a ingrained view right now that we will never have a recession again. You must know that, right? The business cycle has been repealed because we didn't have the recession. We didn't have the recession after the Fed went bonkers on rates like Paul Volcker did. I was expecting recession, didn't come, but I wasn't expecting that we were going to have 5 years of such massive fiscal stimulus. What Joe Biden did was absolutely incredible. I never anticipated that we're going to have 5 years in a row of deficit GDP ratios in excess of 5%. Do you know how crazy that is? Do you know the only time that's ever happened in U.S. history was in World War II? Not even FDR in the 1930s Great Depression ran fiscal deficits 5% plus. And of course, there's a lot of subsidies in there, and there's a lot of, student debt relief and other mortgage debt relief. So much was in there, subsidies and spending. And so people that missed the recession missed it because what happened with interest rates got overwhelmed by this rampant fiscal policy. It's led people to believe that there will never be a recession again, and that scares me because I believe in cycles. I believe in the business cycle. And there's people that actually firmly believe that we will never have a bear market again. Do you know that, right? That is the only way you can rationalize how the equity risk premium is zero. When investors are treating treasury bills and equities in the same risk bucket. You know how crazy that is. Last time that happened for any length of time was in the late 1990s. How well did that turn out? When the ERP is zero, and the United States is the only market where the ERP is zero, where investors do not get compensated for risk on top of the risk-free rate. When we're treating treasury bills and equities in the same risk bucket, what is the market telling you? What are investors telling you? Investors are telling you for that to only make sense would mean that the stock market will never go down again. And I tell my clients, if you believe the stock market will never go down again, well then the ERP at zero makes perfect sense. Go ahead and load up more on stocks. But I don't believe in new eras. I believe in the laws of mean reversion. I believe in Mother Nature, and I believe in cycles, economic cycles and market cycles. And I think that 2 years of 25% price returns in the S&P 500 has caused investors' minds to turn to sludge. I've seen something like this many times before, but never to this magnitude. Maybe what should be my biggest concern, maybe it's tied for my biggest concern, with the fact we're on the precipice of the first global trade war since the 1930s, I think we should all be concerned, is what is the impact on the wealth effect on spending if we go into a bear market in equities? The stakes are very high, much higher than any other time in my professional career.